You want to save for your kids' future. Maybe college, maybe just life. Two accounts keep coming up, the 529 plan and the custodial account. They sound similar. They are not the same tool. Pick the wrong one and you could lose thousands in taxes or financial aid. Let's break it down. Welcome back to Cribside Finance, where we break down the money moves new parents actually need to know, the deadlines, the numbers, and the mistakes that cost real money if nobody tells you about them ahead of time. No fluff, no generic advice, just the actual dollar amounts and actual deadlines for each stage of your kid's first few years. A 529 plan is a tax-advantaged account built specifically for education. Money grows tax-free, and withdrawals are tax-free too, as long as you spend them on qualified education expenses, tuition, room and board, books, even K-12 tuition up to a limit. A custodial account, UGMA or UTMA, is basically a regular investment account that you manage on behalf of a minor. There's no restriction on what the money is used for. It could be college, it could be a car, a gap year, a business. The core trade-off, 529 plans gives you tax breaks in exchange for restrictions. Custodial gives you freedom in exchange for losing those tax breaks. Here's the part most people get wrong. There is no federal annual contribution limit on a 529 plan. You could put in $1 or $100,000 in a single year. The IRS doesn't cap it. What actually limits you is the gift tax. In 2026, you can contribute up to $19,000 per beneficiary without filing anything, $38,000 if you're married and both contributing. Go above that, and you're not taxed, but you do have to file a gift tax form and it chips into your lifetime exemption, which sits at $15 million per person in 2026. There's also a move called superfunding. You can front-load 5 years of contributions at once, up to $95,000 as an individual, or $190,000 as a couple, and elect to spread it over 5 years on your tax return. That's a powerful way to get a big lump sum invested and compounding early. On top of that, every state sets its own lifetime cap per beneficiary, typically somewhere between $235,000 and $600,000 plus. Once you hit that number, the account can't accept new contributions, though it can still grow. Custodial accounts, by contrast, have no contribution limit and no lifetime cap at all. The only thing that touches them is that same annual gift tax exclusion if you're gifting the money in. This is the one people underestimate. With a 529 plans, you stay in control, forever, or until you transfer it. You decide when money comes out and what it's used for. If your kid decides not to go to college, you can change the beneficiary to another family member, or even roll a chunk into a Roth IRA for them under newer rules. With a custodial account, the money legally belongs to the child the moment it goes in. You manage it until they hit the age of majority, 18 or 21, depending on the state, and then it's theirs. All of it, no strings attached. They could blow it on anything, and you have zero legal say. This is where a lot of families get burned. A 529 plans owned by a parent counts as a parental asset on the FOFSA, assessed at a max of 5.64%. Custodial accounts are considered the child's asset, assessed at 20%. That's a huge difference. $10,000 in a custodial account can reduce financial aid eligibility 4 times more than the same amount in a 529 plan. If financial aid is even a possibility for your family, this alone often settles the debate. 529s aren't as rigid as they used to be. You can now use them for K-12 tuition, apprenticeship programs, student loan repayment up to a lifetime cap, and, as of recent rule changes, roll leftover funds into a Roth IRA for the beneficiary, within limits. But if you pull money out for something not education-related, you'll owe income tax plus a 10% penalty on the earnings. Custodial accounts have no penalty, no restriction, ever. That flexibility is the whole appeal, but it comes with a trade-off. No special tax shelter, and the money is irrevocably the child's once transferred. Ask yourself 3 questions. Is this money definitely for education? 529 plans win on taxes and financial aid. Do you want flexibility for non-education goals, or want to give your kid full ownership someday? Custodial account wins. Might you need financial aid? 529 plan wins, almost every time. Many families actually use both. a 529 plan as the core education fund, and a smaller custodial account for general savings or teaching a kid to invest. Neither account is better, they're built for different jobs. A 529 is a scalpel, precise, tax efficient, built for one purpose. A custodial account is a Swiss Army knife, flexible, but with fewer built-in advantages. Know what you're optimizing for before you open either one. Next up, the child tax credit. How much it's actually worth, the income limits that phase it out, and the deadlines you can't miss. Subscribe to Cribside Finance so you catch that video, and everything else coming up.